Netflix is up huge after hours after reporting earnings. After hours yesterday. Can you believe it? Ended somewhere around 9.5%, 9.25% up after hours due to their earnings report. So we're going to go ahead and take a little look at this and see what exactly is going on here. Why is it this way? That's a good question for you. What's going on here? So we'll take a look at that report, see everything that's going on. So obviously, to have a stock jump that high, you're usually looking for a pretty good report, right? Which, I mean, look what you see here. I mean, EPS of $1.47 per share, which beats by 42 cents per share over estimates. That's insane. Revenue in line, 31% growth year over year. Streaming memberships, 21%, 21.4% year over year. Alrighty, that's not bad at all. They're a little short of their guidance here, and we'll get a little bit more in depth in that shortly. So net additions this quarter of 6.77 million. So a lot of this reaction, I believe, is due to the major growth in profit, for sure. I think if we're looking at negatives, which I will certainly get into negatives, I have mixed feelings about this earnings report. I do believe that a 10% jump is a little bit egregious to consider, but we'll see. We'll see how things open up tomorrow. But a lot of this, I believe, is just due to that insane profit number, right? Operating margins increased to 18.7% from 12% a year ago. That's pretty significant. I mean, operating income doubled. I mean, it's crazy that profit's coming out of nowhere, and that's always been a significant thing for Netflix. Is they haven't been certainly not the most profitable company. I mean, you think about a 12% margin, that's certainly not good. I mean, it's kind of just what happens though. You pay for content, and sometimes you don't necessarily get the best margin out of it. That's why they had to up their pricing on their streaming service, because that's they needed to start making money. They've always had trouble making too much money. They haven't really made enough. So the forecast was 7 million subs for the quarter. They hit 6.77. So if we're going to look negative, why do I think a 10% is unjustified? And I do think 100% of the jump was entirely due to profit. And that's certainly a realistic thing, but if we're looking, they still missed their guidance on new subs. I don't know. I mean, if we're looking last quarter, it was a horrible quarter in which they actually they only grew 2.7 million, and they actually lost subscribers in the U.S. So they were calling for 5 million net adds, and they only ended up getting 2.7. So again, the stock got beat down from that. So obviously this could be a little bit of a makeup for it. It's hard to say that. I mean, if we look year to date, this is a stock that's gone up 7%. So not awful, not an awful year. But if we're looking at the 1 year chart, down 21%. So pretty much stagnant over a year's period. Year to date's not bad, but overall still not much movement in the stock. For a high growth company, year over year just not that much growth. So again, I don't want to harp on this. The stock got hammered when they missed their subscriber goal previously, and they missed it again, and it went up significantly. I mean, they missed their yearly goal as well, so it's something to consider when looking at this. We'll move on. So pretty much Netflix saying competition's okay, and for the most part, I absolutely agree with them. So we're kind of transitioning to a time where streaming service, I mean, to be frankly honest, cable's not going to be around in 10 years from now. It's cheaper to have streaming services. And to Netflix's point here, it's not necessarily competition in a sense when a lot of people, it just makes sense to be using these, 3 or 4 streaming services as opposed to cable because it's much cheaper that way. It's honestly a cheaper bill and you get just as much content, and it just makes sense that way. So that's why competition is really okay, because you can have multiple services. It doesn't necessarily have to be one or the other. Now, as far as long term, I do still prefer a Disney Play as far as that's concerned. As far as growing new subscribers, I think obviously Disney Plus is going to be, the headline of that. I think Netflix is noticeably decreasing their, decreasing what they're doing year over year in terms of their subscriber growth. We'll take a look at the yearly chart there. But as far as this is concerned, I do understand where they're coming from. It's not necessarily competition wins everything here in the streaming game, because in the end, the only one getting hurt by this is cable companies, really. I mean, these are the companies that are really going to get hurt because people are going to unsubscribe from their cable. And I mean, everyone, you can ask anyone. A lot of people are planning on getting rid of cable and strictly streaming, going to streaming services, and it makes a lot of sense to do that. It's a lot cheaper. So we'll get more into the numbers now. Looking at their earnings here. So one thing to trace here, obviously revenue. If you're looking from Q3 18 to Q3 19, significant change here. Obviously great growth. Something to look at. They're forecasting great growth as well. Forecasting 30% growth. I think it is very noteworthy. This is, again, where I find concern. Their forecast wasn't good. I mean, that's just my opinion. I don't think their forecast was good. And typically, when a forecast after earnings isn't good, you usually see the stock usually falter after the initial reaction's positive. But they're calling for operating income. Half the operating income of what they just made this quarter, and less than that of what they made in Q2. So, I mean, what's the difference there? Why are they anticipating a lower margin, operating margin of 8.7? What's the deal as to why they're anticipating half the margin? That's obviously not a great sign, personally, in my opinion. I mean, this is the lowest margin they've had, out of 5 quarters. There's only one quarter that's been lower than an 8.7 forecast. I don't know if they're sandbagging the numbers maybe, but I mean, net income, weak. That's some weak net income numbers and weak EPS numbers. So obviously, I know a lot of this EPS and profit that came from this quarter was boosted by it was some legal situation they had where they got a lot of extra cash from it. But I mean, to me, investors should see that and not necessarily buy in so heavily. Up 10% is a little bit crazy of a reaction, especially with a forecast like this. To me, it's, I don't like seeing you're expecting half the profit next quarter. I mean, this is a company that already struggles in the field of, debt to cash. And if you're telling me they're going to be making less cash, I mean, I don't like that. Personally, I don't like that. But, I mean, they're not giving forecasts for net cash used, which is fine. But if you look at these streaming additions, I hate to say it, but declining again. Year-over-year growth, down to 19.2% year-over-year growth. Adding only, sandbag 7 million next quarter, 7.6 million, and you couldn't hit 7 million this quarter, so even that forecast seems a little bit high in my opinion. A lot of that, it all comes with content, and I think that part of what helped this quarter as well was Stranger Things season 3 coming out. It's usually their staple shows that get people subscribed for a month or whatever it might be just to watch that series, and then they could unsubscribe. That is, I know people that do that. They just watch it for a single series. They They subscribe for a month, paid $12, and then, you know what? They're out, right after that, after they watch what they wanted to do. They're going to need some content here in Q4 if they want to see that number grow, We'll entirely see how that goes. If we're moving on, obviously, I mean, this is all over the board in the past 4 years, as far as where their growth finds. Obviously, last quarter was very rough. They came in under estimates again this quarter they just reported. But for the most part, they've been beating on their estimates of growth, Q1 this year was fantastic for them. Q4 last year was fantastic for them. If you look historically, Q4s tend to be very good beats for them, but they're forecasting around 7.6 million, and if you look historically, I mean, they hit it last year, so I mean they certainly can hit it. But my only concern in that aspect would be competition. It's very interesting, right? Competition is certainly a factor. I don't know if people are going to be necessarily adding Netflix. They might be trying out the new streaming services coming out, such as Disney Plus, Apple TV Plus. They could try those first and then consider joining Netflix after that. Not everyone's going to be already deciding what packages they want. Like, they want Netflix, Hulu, Disney Plus, Apple TV. They're not going to say that immediately. Usually they're going to test out these services, whether it be free trials or just little sample runs of like a month or so. So we'll see how that goes. Interesting to note here too. U.S. subscribers still trailed pretty significantly to estimates. Forecast of 800,000, only got 500,000. Again, quarter two they lost subscribers in the U.S. So obviously it's good that they're adding, but they're certainly missing that number. It's something to consider. Obviously you don't want them missing numbers, but they are. Here's a little bit of a graph here. Nothing significant. Obviously falling a little bit short of net paid ads increased of 2018. A little bit short. Started off the year pretty hot, but we'll see how that goes. So obviously this one just speaks about content. Quarter three, talked about a couple of different shows. Nothing too exciting, in my opinion. Obviously they speak about final series, Orange is the New Black, which is the most important TV show of the decade. It's actually a garbage TV show, but we'll entirely see. It's interesting to see what content they're going to go ahead and put through. We're going to scoot through that. Get into the important stuff as far as cash flow is concerned, obviously. Operating activities was negative 502 million versus negative 690 million prior, so that is good, certainly good. Free cash flow totaled negative 555 million, or 551 million versus negative 859 million, so that's good. I mean, we'll take it, but obviously this expected free cash flow of negative 3.5 billion, I don't like it personally. I don't like it. That's me. That's just me as far as I'm concerned. So again, now we're going to be looking at U.S. streaming here. Obviously, forecast of 0.6 added. So that's 600,000 added. A lot of where their growth finds, it's all international now. That's really where they're finding their growth. Decrease in free trials used even. But look at this profit margin. It's just, that margin on international streaming of 10, I mean, that's a significant factor. If this is a big majority of your business, I mean, why? I mean, you're focusing on growth here, but you're not making money on it, obviously. So we'll see how that entirely turns out. They might just be focusing on growth and then, shifting that focus to profitability later. That's exactly what they did with U.S. streaming. So it's something to look at for sure. But again, yeah, you can see this Q2 number where they missed and, lost 130,000 subscribers, which is pretty crazy for them. But U.S. numbers are, stagnant at this point. That's what's a little bit curious for me. if we're looking at financials here, obviously there's pretty good revenue growth. Certainly, cost of revenues normally that'll go up. Cost on marketing actually decreased this quarter, so that's not necessarily awful. Anytime you can decrease cost, for the most part, I mean, and that's really what you see all around. I mean, costs for the most part just decreased, and that's why you see that profit increase for this quarter. That's why you see more profitability. Now, there's certainly some concerns here. Net income, obviously, very good quarter, but overall, net income's a concern for the company. If we're looking about total assets, so I mean, current cash on hand of $4.4 billion, right? And I'm a huge factor. I'm a huge thinker of debt. If I'm looking at debt here for the company, $12.4 billion, but only $4.4 billion in cash, right? I don't know about you, but I personally find that slightly concerning again, especially if you're now trimming your expectations on profit for the following quarter. Where's that going to come where you can pay down that debt? If you're expecting only to, have net income in a quarter of 200 million, where are we going to be getting rid of this, long-term debt of 12.4 billion? That's going to take forever, To each their own. Again, I'm not necessarily an investor in companies that don't make money traditionally. There are very few companies that, if I do invest in a company that doesn't, make that much money, or they're heavily in debt, there's got to be a good reason. I think if we're looking at valuation, I still don't like the valuation of Netflix, right? Obviously, it's been stagnant over the last year, but this is a company right now that's trading at a PE of, 112. It will adjust after this quarter, so that's not necessarily an accurate number now. With a forward PE of 50, the valuation's still high on this company. It's still very high. Price to sales of 7. This is price to book of 20. This is a very highly valued company, and there's no arguing that. And I certainly try to stray away from companies that are so highly valued. That's my perspective on it. I certainly don't like overvalued companies that much, but sometimes you invest in them. It's fair. I don't blame people for investing in them. That's really all I have to say as far as we're concerned with this earnings report. I think that the jump was unwarranted. I don't want to take a poo-poo on Netflix stock that much, but I do think that 10% was maybe a little bit of egregious of a jump, and we'll see how things go. I'm recording this the night of. We'll see how things open up tomorrow. I'll be interested to see if it opens again 10% higher. I don't think it will. I think when people digest their actual guidance, which it's not good guidance, I don't think it'll be good. If they beat next quarter, I think we can see a jump, but I just think overall we shouldn't see that much of a jump in stock price from this quarter. I just don't think we should. I don't think there was all that much to be impressed about in terms of guidance. I think it was, I hate to say a fluke quarter, but slightly a fluke quarter. Even they're guiding for this to be a fluke quarter, so we'll see how that goes. Hope you enjoyed.